While the world focused on rate cuts, CPI prints, and equity rebounds, the real event happened inside the overnight repo desks and collateral vaults. Screens showed stability, spreads looked contained, official statements repeated the word orderly. But beneath the surface, liquidity stopped moving. This was not a crash. It was a pause, brief, surgical, and lethal. In the repo market, trust is collateralized belief. Cash is exchanged for securities not because they are valuable, but because they are immediately convertible. When that assumption breaks, the system does not unwind slowly. It locks. Paper claims continued to trade. Prices updated. Algorithms recalculated. But physical settlement hesitated. Haircuts widened without explanation. Overnight funding rolled, then didn't. What was supposed to be temporary became conditional. This was not caused by panic. It was caused by arbitrage failure, margin pressure, and a quiet realization spreading desk to desk. The collateral everyone depended on was already spoken for. No announcement marked the moment. No headline captured it. Yet from that point forward, every transaction carried a question it was never designed to answer. What if delivery is optional? This is the story of how a market built on velocity encountered friction, how institutional confidence fractured without noise, and how system stress migrated from paper to physical, not as a forecast, as a sequence already in motion. What appeared to break was nothing visible. Markets opened on time, trades cleared, screens refreshed without interruption, equities absorbed volatility as they always do, bond yields adjusted by fractions, framed as rational responses to data. Central banks spoke in practice language about balance and patience. From the outside, the system looked functional, liquid even. But motion is not liquidity. What the public saw was activity. What actually happened was compression. Repo volumes remained elevated, yet fewer institutions carried more weight. Overnight funding continued to roll, not because conditions were healthy, but because failure to roll was not yet permissible. Balance sheets operated close to their internal limits. Tolerance disappeared long before capacity did. This was not stability, it was maintenance. Liquidity was assumed to be renewable. In reality, it was being reused. The same dollars, the same collateral, circulating through narrower channels at higher velocity. The screen showed abundance. The dock showed congestion. The causal chain was already in place. Liquidity remained unchanged while leverage expanded. Arbitrage opportunities appeared small but persistent. Dealers extended balance sheets to capture them. Repo funding shifted from convenience to necessity. The arbitrage itself was rational. Price discrepancies across maturities and instruments invited participation. The models worked. The math cleared. But every position depended on uninterrupted funding. Remove the roll, and the trade inverted from profit to liability. Liquidity was not withdrawn, it was withheld. Cash stayed inside the system, but movement became conditional. Counterparties mattered more. Terms tightened quietly. Haircuts widened at the margins, not enough to trigger headlines, but enough to change behavior. Margin pressure increased without a spike. It was friction, not shock. Institutional exposure concentrated where duration met leverage. Dealers funding long positions overnight accepted the risk because the system had trained them to. It had always rolled, until it didn't. This phase resembled a queue that still moved. As long as it advanced, no one questioned it. But spacing narrowed. Exits became theoretical. One pause would be enough. Escalation had not yet begun publicly. Margin hikes were discussed in internal committees. Trading halts were unnecessary because prices remained orderly. Rule changes existed as contingency drafts, not announcements. History rhymed quietly. In early 2008, repo markets functioned days before freezing. In 1980, silver rules changed only after positioning made continuation impossible. Stability always persists until it is no longer allowed. The stress increased because optional liquidity became mandatory liquidity. Every additional layer of leverage reduced tolerance for error. Silence replaced signal. Real-world indicators whispered. Dealer premiums began to diverge by counterparty rather than asset quality. Delivery timelines stretched, then normalized, then stretched again. Inventory classifications gained importance. Eligible supply looked ample on paper. Registered availability was discussed less. Industrial demand did not decline. It pressed upward beneath static prices. These were not warnings. They were confirmations without volume. And systems that rely on noise to detect failure rarely hear the moment when the sound disappears. The break did not arrive as a headline. It arrived as a hesitation. Overnight repo still printed. Transactions appeared to clear. Rates moved inside acceptable bands. From the outside, funding markets looked operational. Screens updated. Systems reconciled. But something changed. Roles that were once automatic became conditional. Counterparties asked questions they had not asked before. Specific collateral was declined without explanation. Haircuts widened unevenly, not across the board, but desk by desk. What the public saw was continuity. What actually happened was selectivity. The overnight market is designed for indifference. Collateral should be interchangeable. Cash should flow without judgment. When discretion enters the process, the structure changes. The market does not fail, it filters. The causal chain was precise. Liquidity conditions tightened at the margin. Dealers approached balance sheet limits. Repo lenders reassessed counterparty exposure. Overnight funding became permissioned. Arbitrage incentives were still present. Price dislocations had not closed. Models still implied profit. But the exit depended on rolling funding, and rolling funding was no longer guaranteed. This is where margin pressure becomes nonlinear. As collateral acceptance narrowed, positions that were neutral on paper required additional capital to maintain. Margin calls did not explode. They accumulated. Each adjustment forced a choice: add capital, reduce exposure, or seek alternative funding. Alternative funding did not exist. Liquidity was not removed from the system. It was trapped inside institutions protecting their own survival. Cash became conservative. Balance sheets became defensive. The vacuum did not pull everything at once. It pulled selectively. The simplest analogy is a bottleneck. Traffic still moves. Cars still pass through. But capacity is reduced and delay compounds. Those at the back feel nothing until they do. Institutional exposure widened rapidly. Hedge funds dependent on overnight leverage felt pressure first. Prime brokers absorbed stress next. Clearing members monitored collateral quality with increasing scrutiny. No one announced panic. They enforced policy. Escalation followed a familiar rhythm. Margins were adjusted quietly. Position limits were reviewed. Trading desks reduced inventory voluntarily. There were no halts because prices had not yet reacted. This mirrored 2022, when the nickel market functioned until liquidity vanished. In 2008, when repo froze after days of normal operation. The freeze is never announced. It is inferred. Signals emerged outside the screen. Dealer premiums diverged sharply for identical instruments. Delivery confirmations slowed. Settlement optionality crept into conversations without being documented. Inventory classifications mattered more than total supply. Eligible collateral existed. Registered availability did not move. Industrial demand continued uninterrupted. Physical requirements did not pause for funding stress. The silence was the signal. Overnight markets are not supposed to pause. They are supposed to reset trust every evening. When they hesitate, even briefly, it implies something deeper than volatility. It implies that liquidity is no longer assumed. And once assumption is replaced by evaluation, the system begins to reprice itself, not in price, but in permission. What broke next was not price discovery, it was reversibility. On the screen, spreads still existed. In some cases, they widened. Opportunities appeared. The math suggested convergence. Models flagged inefficiencies that should have been harvested. What the public saw was mispricing. What actually happened was entrapment. Arbitrage assumes two things: time and funding. Time allows convergence. Funding allows survival until it arrives. When funding becomes conditional, time turns hostile. Positions that had been neutral suddenly carried weight. The causal chain was mechanical. Small dislocations created arbitrage incentives. Arbitrage required leverage to matter. Leverage required overnight funding. Overnight funding became selective. When selectivity entered, exits disappeared. Margin pressure intensified, not because prices moved violently, but because funding terms did. Haircuts increased asymmetrically. Collateral once accepted universally now required explanation. Each adjustment forced additional capital into positions that were already fully optimized. This is where the system inverted. Positions that were correct became dangerous. Positions that were liquid became immobile. Liquidity was not withdrawn from markets. It was redirected inward. Institutions protected balance sheets first. Cash stopped circulating across desks and subsidiaries. What remained was a liquidity vacuum that pulled from the weakest points. The analogy here is a vacuum seal. As long as air flows, pressure is equalized. Once sealed, removal accelerates collapse. You do not feel the force until movement stops. Institutional exposure escalated quickly. Hedge funds running basis trades faced escalating margin requirements without corresponding price relief. Prime brokers absorbed risk until internal limits forced reduction. Clearing members recalculated worst-case scenarios, assuming delayed settlement, not default, but delay was enough. Paper claims still existed. They could be valued. They could be transferred, but they could not always be closed. This was the critical divergence. On the screen, trades could be marked. At the dock, assets could not be mobilized fast enough. Escalation followed history with precision. In 2008, arbitrage failed when repo funding froze and spreads widened beyond solvency. In 2022, the nickel market halted, not because of price discovery, but because clearing could not absorb margin shock. In 1980, silver rules changed once concentration threatened delivery. In every case, arbitrage died first. Margins increased again. Internal risk limits tightened. Certain trades became non-viable overnight. No public halt occurred because the system still functioned mechanically. Clearing happened. Settlement windows stretched quietly. Rule changes remained internal, but contingency language hardened. Real-world signals intensified. Dealer premiums diverged further, reflecting balance sheet scarcity rather than asset value. Requests for specific delivery terms increased. Inventory classifications mattered more than totals. Eligible supply remained plentiful on paper. Registered availability became static. Industrial users did not slow, they could not. What emerged was a market where paper could circulate freely, but physical movement lagged. The divergence was no longer theoretical, it was operational. And once arbitrage loses its exit, markets stop correcting themselves, they begin rationing instead. What broke at the institutional level was not solvency, it was willingness. Publicly, nothing changed. Statements remained measured, funding facilities stayed open, market structure appeared intact. From the outside, institutions looked calm, methodical, in control. What the public saw was discipline. What actually happened was containment. Risk committees met more frequently. Balance sheet usage was repriced internally. Activities that had been routine were reclassified as discretionary. Liquidity did not disappear. It was prioritized. The causal chain tightened. Arbitrage positions strained funding capacity. Margin pressure accumulated without release. Balance sheets approached internal limits. Institutions shifted from intermediation to self-preservation. The shift was quiet but decisive. Liquidity was no longer deployed to smooth markets. It was conserved to protect capital ratios, regulatory thresholds, and internal stress assumptions. The system still functioned, but it stopped absorbing shock. The analogy here is a bottleneck valve. Flow continues, but pressure builds behind the restriction. Those upstream feel nothing. Those downstream feel everything. Institutional exposure widened beyond hedge funds and trading desks. Prime brokers became transmission points. Clearinghouses monitored collateral quality with increasing intensity. Systemically important dealers faced a conflict: provide liquidity or preserve balance sheet integrity. They chose preservation. Escalation advanced through policy, not panic. Margins were increased again. Certain products required additional approvals. Position limits were adjusted downward. No trading halts were announced because prices still behaved. This mirrored 2008, when liquidity vanished before equity indices reflected distress. It also echoed the 2022 LME nickel halt, where intervention arrived only after clearing risk became visible. Here, clearing risk was recognized early. Internal rule changes preceded public ones. Settlement assumptions were stress-tested under delay scenarios rather than default. Force majeure language entered internal memos without being invoked. Silence dominated external communication. Real-world signals became harder to ignore. Dealer premiums detached from benchmarks, reflecting balance sheet scarcity. Delivery confirmations slowed and fragmented. Requests for substitution increased, then stalled. Inventory classifications hardened. Eligible supply remained abundant in reports. Registered availability stopped declining, not because demand faded, but because movement slowed. Industrial demand continued. Production schedules did not adjust to funding stress. This was the turning point. Markets can tolerate volatility. They can tolerate losses. They cannot function when institutions stop absorbing imbalance. Once containment replaces intermediation, stress no longer disperses. It accumulates. And accumulation does not announce itself with noise. It announces itself with inaction. What broke next was not trading. It was the framework that made trading meaningful. On the surface, markets remained open. Prices printed. Contracts stood. There was no declaration of emergency, no visible suspension. The public saw continuity. What actually happened was redefinition. As stress intensified, institutions stopped relying on markets to resolve imbalance. They relied on rules. Internal policies hardened. External frameworks became flexible. What had once been automatic became conditional. The causal chain was direct. Liquidity stress limited balance sheet usage. Margin pressure forced prioritization. Institutions reduced discretionary exposure. Rules were adjusted to preserve continuity. Arbitrage incentives no longer mattered. The opportunity to profit was irrelevant if exit could not be guaranteed. Liquidity removal accelerated, not because capital vanished, but because it was fenced. The analogy here is a gate. It does not stop movement. It controls direction. And once closed, pressure builds where it cannot be seen. Escalation followed historical precedent. Margin requirements increased again, but selectively. Certain contracts required higher quality collateral. Settlement timelines were extended without announcement. These were not defaults. They were accommodations. This mirrored 1980, when silver rules were changed not to halt trading, but to make certain outcomes impossible. It echoed 2008, when collateral standards shifted faster than capital could adjust. It recalled 2022, when nickel trading halted only after rule flexibility failed. Here, flexibility came first. Force majeure was not invoked. It did not need to be. Its logic entered quietly. Performance was defined as best effort under conditions of stress. Delivery remained expected, but timing became interpretive. Institutional exposure migrated outward. Clearinghouses protected themselves. Dealers passed constraints downstream, and participants absorbed uncertainty they had not priced for. Paper claims remained enforceable. Physical fulfillment became conditional. Real-world signals confirmed the shift. Dealer premiums spiked relative to screen prices. Requests for physical delivery increased, then encountered delay. Inventory categories hardened into barriers. Eligible stock appeared ample. Registered availability stopped responding to demand. Industrial pressure intensified. Production did not pause for rule changes. This was no longer a market discovery process. It was a control process. And once rules replace markets, price ceases to be information. It becomes permission. What finally broke was not confidence. It was delivery. Up to this point, stress lived mostly on screens and inside institutions. Paper claims circulated. Contracts remained valid. Prices updated. The system could still argue that nothing fundamental had failed. What the public saw was persistence. What actually happened was drain. Requests shifted in character. Participants stopped asking whether positions could be rolled and began asking whether they could be settled. Physical metal, once an afterthought in a paper-dominated system, moved to the center of risk management. The causal chain completed itself. Rule changes reduced market flexibility, liquidity constraints, limited balance sheet support. Margin pressure forced position closure. Participants sought physical certainty. Arbitrage incentives disappeared entirely. There was no profit in convergence if settlement could not be guaranteed. Paper claims continued to exist, but their credibility depended on access to finite inventories held in specific locations. Liquidity was not just withheld now, it was exhausted. The analogy here is a reservoir under drawdown. Outflow exceeds inflow quietly at first. Levels drop without alarm. Then suddenly, nothing comes out. Vaults became the focal point. Inventory reports showed stability in aggregate, but movement told a different story. Eligible categories remained large. Registered stock stopped responding. Transfers slowed. Reclassification replaced delivery. Each action preserved the appearance of supply while reducing actual availability. Institutional exposure shifted again. Clearinghouses prepared for delay scenarios. Dealers limited physical commitments. End users discovered that possession mattered more than price. Industrial demand did not decline. It competed. Escalation reached its final form. Margins were no longer the primary stressor. Halts were no longer effective. Rules had already been bent. What remained was default risk, not as insolvency, but as inability to perform on time. Force majeure did not need to be declared to be felt. The system behaved as if it already had. Historical echoes converged. In 1980, physical silver availability determined the outcome, not futures prices. In 2008, delivery failure preceded equity collapse. In 2022, the nickel halt confirmed that clearing cannot function without physical certainty. The pattern held. Real-world signals were unmistakable. Dealer premiums detached completely from screen prices. Delivery delays became structural rather than temporary. Inventory classifications turned into barriers. Industrial buyers paid what was required, not what was quoted. The divergence was complete. On the screen, value still existed. At the dock, capacity did not. And when physical systems reach constraint, markets do not negotiate. They ration. The price on the screen remained a calculation. The physical system operated under constraint. When delivery becomes conditional and liquidity stops circulating, the outcome is not volatility, it is inevitability.